So you saw the Lambos, you heard about the fast, easy money, and you found your way into trading like most of us. Then, if you stuck around for a little while, you realize that that's mostly bullshit. Now, the really cool part about trading is that there genuinely is asymmetric upside potential. It means you can make a lot of money, but it's not the fast, easy money people hope that it is. It's not the look at one line on a chart that's magical that generates your returns. It's not just sell options and rake in the income. There's a lot more nuance to it. There's actually a lot that has to be done by an individual. You have a lot of tasks to accomplish. This is one of the big differences between really, really big trading firms, institutions, and a retail trader. Institutions have all these broader processes that have a lot of built-in knowledge that a new person comes into and benefits from that structure. There's a risk management department, there's a research department, there's an execution side to it, but they don't even execute everything. They execute a piece of a thing. As a self-directed retail trader, you literally have to learn how to do all of those. Now, juxtapose that against where your starting point is. Your starting point is you're really worried about the outcome of a single trade. You have completely missed the forest from the trees. And if you think about anybody that's really good at stuff, take Tom Brady, for example. He didn't become what he was by just worrying about only one thing, but he also didn't become what he was by worrying about everything at once. What I'm highlighting here is when it's time for him to throw the ball, he's really focused on throwing the ball in that moment. However, into that moment, there was a lot of stuff that he did, both before the event and during the event. Before the event was making sure that his diet was right, his rest was good, so on and so forth. During the event is making sure he's reading the defense well. All of those things take a baked-in process. And the way that he won as many Super Bowls as he did wasn't worrying about doing it well once. He was worried about doing it well consistently. You can find this across high performers everywhere. Gordon Ramsay, he didn't build a culinary empire by just making one single dish well. He obviously built an entire process that people could learn and then execute on their own. That's the nature of trading in a nutshell. There are a lot of processes that you have to do. This video is going to walk you through 8 broad processes that literally will transform your trading capacity. That being said, there's a ton of sub processes that go into this. My main goal for this is to shift your mind from being so concerned about the outcome of individual trades and instead focusing more on how does each individual trade represent a sample that then is part of a broader strategy executed as a process over time. If you trade long term, you are measured in literally tens of thousands of trades, not any one. So let's take a look at these 8 processes. The first one we're going to cover is goal creation and financial foundations. Then we have foundational knowledge, market observation and context, research methodology, profit mechanisms. Then we'll get into the next 8 after these. What I'm going to do for each of these is give you an overview of an end state, what you should be able to do as you iron out this broader process. So in the process of creating a goal, you should have a method to create a budget. You should have a method to adhere to it. You should also build your entire roadmap around this idea of compound interest. There's other things that go into this, like making sure you have good base finances, not having any big credit card debt, not having any sort of auto loan, which is a terrible, terrible, terrible kind of debt to have because it's on a depreciating asset, making sure you have an emergency fund, all those kind of things. Now, one of the notes that you'll have as we go through these processes, what makes a process what it is that it's iterative. It goes around in a circle. And it's important to keep that in mind because these things will iterate over time. So, for example, your original goal will probably change. Mine did. Your concept of what a 6-month emergency fund might change. Mine did. So on and so forth. So, this first process is literally just getting all of those base things laid out to have a solid foundation for the next step, which is focusing on your foundational knowledge. Now, there are tools you can use to help you with these. So, for example, in the goal creation and financial foundations, the pro members have access to what I call a money mindset and marginal utility exercise. This is something I actually built for myself that I ended up sharing more broadly because I think it's useful. The whole point of this is to help somebody orient on what actually matters to them and what actually drives a lot of your marginal utility, not the superficial stuff. It takes a decent bit of self-reflection. Now, as we get into foundational knowledge, there's a lot of great materials. So, for example, reading anything from Ewan Sinclair, reading Options as a Strategic Investment by Lawrence McMillan, reading Positional Options Trading, specifically by Ewan Sinclair, which is kind of like a newer version of Option Volatility and Pricing by Natenberg, which is also a must read. I'll throw links to all of those in the description so that literally you can go to Amazon and see the exact books that I think make sense to start with. That's how you start developing foundational knowledge. This is also where you begin to understand how markets actually work, how exchanges work. You start getting a grasp of this world that you're stepping into. If you think that you're just going to walk into this, make a bunch of money with a little effort, again, this ain't the place. Now, a really, really important aspect of foundational knowledge, which is a shameless plug for our community, the Outlier Pro community, is getting feedback. Because if we go back to the institutional side of the equation, a big part of learning within an institution is you get feedback. You have more experienced people that see what you do and give you feedback. Now, you can do that in our community. There's a free section that's free for everybody to join. You do it through the Patreon. There's a free tier. But you can also just meet a couple friends, 4 or 5 people that you bounce ideas off of. Any of that's fine. Another accelerator you can use is AI. You could say on a weekly basis, I'm going to sit down and give myself a quiz based on series level information. Boom. And you can sit here and have a quiz given to you so that you can test what you're doing. But you need some sort of feedback loop. Because when you're new and you don't know what you don't know what's good and what's not good because you don't know. How could you? You develop that over time. The other things that you'll learn throughout this is that you have to understand the fundamentals in order to get the bigger stuff right. In the Marine Corps, we call this brilliance at the basics. Going back to Tom Brady, he likely will have spent tons and tons of time focusing on specific parts of his throw so that when he puts the whole thing together, it works reliably, consistently. It's the same idea here. You got to get the fundamentals down. I would highly recommend setting a regimented cadence for yourself, whether it's a certain time block every single week, multiple times throughout the week. What I think is most important here is the more consistent you can do it, the better. And I would favor more but shorter blocks. So rather than a 4-hour block on Saturday, split that 4 hours up throughout the entire week if that's all you have. But the more, the better. This should be a fire hose in the beginning. That's how you're going to learn the absolute most. Next, we need to understand what markets are and how they behave, what they do, how they perform. In this stage, you should develop a baseline for like what's normal, what's abnormal. You'll hear this come out all the time, which is kind of funny because traders will be like, oh my God, volatility is so high. And then you'll look and you're like, man, it's like VIX is like 22, like it's slightly elevated. How do we know VIX is slightly elevated? Well, because if we carve some time to just take a look at VIX and we zoom this out longer term, well, this is over the last 10 years and you can see where it typically hangs out. So the way that you start to develop context is by meaningfully looking at stuff. What that means is if you have a bunch of stuff on your chart or multiple charts and they're just kind of there, but you're not really paying attention to individual details, you're not going to pull much away from that. a big part of being able to do this successfully is shifting your focus, sometimes looking broadly across stuff, sometimes looking very myopically at individual stuff. And you have to ebb and flow between these to develop these deeper relationships. And there's a lot of processes that I use to help with this. So if we take a look at something like a process to analyze the stock market, what I do is I apply like a top-down approach. I'll start with the broader economy themes, then I'll look at the stock market, looking at stuff like indices, volatility, earnings seasons, and then I'll get into individual equities. And this broader process is super important because it gives me a ton of detail about what I'm looking at, and it helps me stay on track so I don't get sucked down into all these different rabbit holes that end up to really not learning much. So in the beginning, this is going to look a lot like just looking at as much stuff as you possibly can. Then over time, you'll refine it down to, once you have a baseline established, to getting more detailed on stuff. This next one is probably the biggest pitfall that exists in trading, in my opinion, effectively bar none, which is developing a successful methodology for researching itself, but then looking at profit mechanisms. Most options traders notoriously learn some sort of option structure, and then they think that that's how they're going to make money. That's not how it works. You have to focus on a profit mechanism first. I have tons of videos that talk about profit mechanisms specifically. I'll link to those in the notes below. But that's the starting point no matter what kind of asset class you decide to trade. In order to research well, you have to learn the ins and outs of what goes into a research process. This is just like when you're in high school and you learn how to conduct a basic research project in chemistry class or whatever, where it's effectively a series of hypothesis testing. You have to understand how to do that. Then the other really big part of researching that I think is generally missed from the broader equation, but you do have to have some context of how to research things and then view it with a statistical lens, like a Bayesian approach, something like that. You can learn all of this from AI if you don't have it. And if you're not picking up the cues here, literally giving you a roadmap in terms of where you should focus and what you should focus on in those sections to develop a process. So before you even start researching what stocks you want to buy, what option structure is the best, you really need to research how to research. You have to learn how to conduct effective research, because there's an entire slew of things I refer to them as trap tasks, where you're kind of doing the things that you have to do, but if you do them poorly, it literally can be more damaging than not even doing the things. And research falls squarely into that. There are tons of biases that will mislead you and will have you believing that maybe something that otherwise is good isn't good, or something that isn't good is good because of favorable path. And this is exactly why getting to this level of detail is important long-term, because all of this builds up into confidence. That comes from the demonstration of a skill and reliably doing so. Next, we're going to cover strategy designs, portfolio management, execution, and AARs. Let's get into it. Strategy design. I have an entire video series about this. I will link to it below, but in a nutshell, what we need to do is take our foundational knowledge that we've built. We need to use what we've observed in the market and things that might offer opportunities. And then once we have a profit mechanism profiled, so that we understand what the profit mechanism is, how it behaves, what it typically does, then we can start worrying about what kind of strategy makes sense here. There's a framework that I've built for you called the outlier strategy process. The entire purpose for this is, again, this is a nested process. This is a process on how to build a strategy. There's 4 steps to this. This strategy process lives in this broader process of understanding how to design stuff. If you create this iterative approach, what you'll find is that a lot of the stuff you look at doesn't work out, doesn't do anything for you. But there will be a small percentage that does. I had a recent interview that I did with Andrew Mack, and he put it perfectly. He's like, when you're digging for gold, you're not going to come up with much most of the time. And then when you do, it's typically pretty asymmetric. That's the nature of developing strategies. It's really time consuming, but once you learn how to do it effectively, it's not that hard. Then we have a portfolio management process. Again, literally I have a video that talks about this exact concept of portfolio management. But like anything else, it requires a process so that you can consistently look through your stuff and make good decisions. I will link to this video below as well. The important aspect here is that it shouldn't just be turn on the platform, do something random. It should be a reliable method to look through what you're doing, to figure out if you need to adjust things, if you need to look for new opportunity, if you're using enough money, if you don't have enough money out, and balance all of that so that you can use your portfolio in a way that actually moves you towards your objectives. In this, you have to be able to execute. This is tricky. The reason why this is tricky is because when it comes to trading, you're the biggest variable as the trader. In order to develop a healthy relationship with execution, if you do the rest of this well, execution literally becomes easy, genuinely. Everything else is done up here. When it comes time to put on the trade, this whole idea of like not being greedy or being disciplined or not being emotional, all of it goes away. You literally lose all of that when you know the thing that you're trading is well researched, you've scoped it, and you have an intuitive understanding of how it behaves. You know why it exists. You've looked at all of the different strategy combinations that you could think of for this thing, and you know the one that you have worked because you've tested it. You understand how all of these individual positions fit together in the broader portfolio. You have risk management protocols at the portfolio and the trade level. When it comes time to execute, you just do it. Like, that's it. Everything is done ahead of this step. So if you're one of those traders that's like, damn, I struggle with discipline, or I struggle with taking winners down too fast or letting losers run, it tells me that we've not done the rest of this. Because if all of this is done, that part genuinely becomes easy. Last thing, AAR process. This is the feedback loop. As I said, all of these things are iterative. They will change over time. The way that I conduct AAR processes, you guessed it, I have a video that goes through this in detail. All of these processes are part of how I've built my trading career. And the way that I think about AARs is I do them weekly, monthly, annually. And that might sound like a lot, but when you're doing this and you realize that you can make 5 times your salary easily in a year, you start to realize, like, yeah, the work is kind of worth it. So this is where you take a look at everything you're doing and you look for opportunities. That's where you identify, like, am I executing well? And again, this is where having an external audit is so important, whether that's with a few friends, whether that's joining the Outlier free community, whether it's joining the pro community where we do live streams as a collective 3 times a week. There's workshops for the Pro Plus members. There's coaching. Again, it's whatever scale that you need. The free side can be completely viable for those that are enterprising and ready to move a lot on your own. But you need something. It's just like when I first joined the Marine Corps, the only way that I learned what I needed to do was soaking it up from others and getting guidance from others, feedback from others. This idea of just going at it laissez-faire and hoping that it works out in trading is really, really unfortunate because the probability of that ultimately working out is low. Now, you also have a great tool that might replace all that other stuff. AI. Use AI if you want. Get a decent membership. It's like $20 a month, whatever. But you need to develop some sort of process where you're analyzing what you're doing, finding opportunities, and then exploiting those opportunities. If you bake in these broader processes and outline some of those sub-processes within, your trading will improve, bar none. There's no step in here that will make you worse off. So the only thing you have to do is fucking do it. Be an outlier. See y'all later.